The comparatively recent asset class of cryptocurrency has made early investors extremely wealthy. Bitcoin and other cryptocurrencies present a unique chance for asymmetrical rewards for traders, investors, and holders. A little bit of money can rapidly grow to be a lot of money, but the IRS demands a share. You are undoubtedly already aware that if you reside in the US, every sale and purchase made using Bitcoins or any other altcoin will be taxed similarly to a stock. This implies that you owe the IRS money if the value of your Bitcoin or cryptocurrency increased at all before you sold it. The situation has become more complicated as a result of the addition of thousands of additional cryptocurrencies over the previous 2 years, especially given that many of them can only be purchased using Bitcoin initially. This implies that each purchase of a cryptocurrency has a potential to result in a tax event. Yes, changing one cryptocurrency for another is now a taxable event. You must establish whether your gains are short-term or long-term and indicate the computations of your gains on your tax return in addition to paying the tax on your gains. Number 1. Purchase cryptocurrencies with an IRA. Based on your retirement strategy, you may be able to buy cryptocurrencies via a self-directed IRA to invest in it tax efficiently. The majority of IRAs let you make regular investments like stocks, collective investment schemes, or exchange-traded funds. Self-managed trading is sufficient, and in precious metals, properties, and cryptocurrencies is possible with certain types of retirement accounts called self-directed IRAs. Finding a self-directed IRA that enables you to invest in the Bitcoin of your choosing is the first step. Before continuing, make sure you are aware of how to purchase Bitcoin in a self-directed IRA of your choice. Your tax advantages will change once you have an account set up based on your tax situation and the kind of IRA you open and contribute to. Traditional IRAs can let you make tax-deductible contributions, but retirement withdrawals will be subject to ordinary income taxes. Roth IRAs demand that you make post-tax contributions, but if you meet the rules, let you withdraw money tax-free in retirement. Number 2. Declare your cryptocurrency as earnings. Taxation operates differently if you are using a cryptocurrency wallet, receive digital currency in exchange for products and services, mine or stake cryptocurrencies, or all three. When you get cryptocurrencies in these circumstances, it is recognized as income. The fair value of the Bitcoin you receive must be documented, reported, and included in your income for tax reporting purposes. This income is subject to ordinary tax rates when you declare it. These have higher tax rates than capital gains. The amount you declare as income is your basis, a tax phrase used to describe the value of the Bitcoin when you first received it. You can use that basis to determine any potential capital gains and pay the associated capital gains taxes when you ultimately dispose of the cryptocurrency. The same is true of Bitcoin mining, but Bitcoin mining is typically viewed as a self-employed activity. This implies that in addition to regular income taxes, you will also need to submit self-employment taxes. Number 3. To minimize cryptocurrency taxes, add losses to gains in cryptocurrency. Currently, cryptocurrency is regarded as property in the United States. Therefore, you are only taxable when you sell your cryptocurrency and experience a gain or loss. The law wants a portion of any profits you made, and if you lose money, you can use it to reduce your earnings. As an illustration, suppose you earned 200K on one coin and lost 160 on another. The gain you made that year, 40K, will be the only amount for which you will have to pay taxes. However, if you don't sell your cryptocurrency, your actual taxes for that year will be zero. If you plan to invest in a project you believe in for the long term, it's likely that when the time comes, crypto will be widely accepted and laws will be favorable to you with lower or no taxes. Number 4. Purchase a loan to avoid crypto tax. Similar to how a mortgaged home serves a collateral for a loan, so does a mortgaged home. Similarly, you can mortgage your digital currencies to a bank to obtain a loan from them. Technically, a loan is not taxable, allowing you to access the current worth of your cryptocurrency without having to sell it outright and incur taxes, and allowing your cryptocurrency to appreciate in the bank. It is a simple way out, but most people are unfamiliar with it, so be cautious when setting it up. When choosing this course of action, think about getting professional guidance. The best approach to minimize cryptocurrency taxes is to have long-term faith in your investment coin. Number 5. In a year with a minimal income, sell your assets. The tax rate you pay is based on your income, regardless of whether you have long or short-term capital gains. Your tax rate will be lower the lesser your taxable income is. Selling cryptocurrencies that will experience gains in years when you know you'll pay taxes at a reduced tax rate could help you save money on taxes. As opposed to what many people think, selling Bitcoin may cause part of your income to be taxed at a higher rate, but does not necessarily cause all of it to go into a higher tax bracket. Number 6, give it to charity. If you itemize your deductions, donations to be registered charity may be a tax deductible. You must have owned the asset for at least a year before giving it to be eligible. Donating assets like cryptocurrencies could result in advantageous tax treatment. Normally, you could write off the market value of your Bitcoin without having to pay capital gains taxes. There are restrictions on the deduction amount, so consult a tax expert to learn how a donation might improve your financial situation. Number 7, give the assets to a friend or a member of your family. You might be thinking, how is it possible to avoid taxes by giving gifts? You know what? Each person is allowed to give up to $15,000 to someone per year without generally having to deal with the IRS about it. According to the IRS, the gift tax must return be filed if you present any one person more than $15,000 in cash or assets in a single year. This does not imply that you must pay gift taxes. The beneficiary may have a low enough income to avoid paying taxes on the appreciated property when it is transferred, even though the basis in the Bitcoin transfers to the new owner. At the very least, you'll pay less in taxes than you would if you sold the Bitcoin yourself. That was all from our side. Hope you enjoyed the video. Let us know in the comment section about your views and don't forget to subscribe for more interesting videos.